The KLCI has been rising since early December last year, but indications are now showing that the rally traditional before the Chinese New Year is tapering off. So what can we expect from the Year of the Dog? Fund managers say that the market can see a gain of 10% this year. So you know the phrase that it gets worse before it gets better? Well, we've already seen the worst in the past 3 years. Now the market can only get better.
Well, traditionally before the Chinese New Year, there could be some kind of a rally and catch up. I think, in fact, some of the stocks during Chinese New Year or after the Chinese New Year, when the volume come back, they also have their own rally.
We are fairly optimistic on the market for this year, at the back of better GDP numbers. Well, when we say that we are optimistic on the market, we are looking at a 10% return on the market for the entire year.
The KLCI obviously was up by 9.5% in 2017. We believe that a repeat of that sort of performance is going to be likely in 2018 due to better corporate earnings growth, a better economic backdrop, and perhaps a stronger currency, and that will attract more inflows of funds.
We like the construction sector in Malaysia this year because of the number of projects that is being farmed out on the rail, the Singapore high-speed rail as well, and the MRT projects. The other sectors that we like actually is consumer staple. Don't forget, we have the World Cup this year. But on the bottoms up, the numbers are stacking very well on the consumer stocks.
The first sector I would think of relates to Chinese New Year would be consumption, consumer stocks. Of course, the other thing would be potentially during this period there could be some kind of advertisement come out and all these things. So media could be the other one. Besides that, I think the banking stock. I think there are people worry about potentially on the new IFRS 9, the kind of things. But after this period, I will see hopefully that the banking sector, because which is a proxy of economy, will able to catch up with the economy. So that, and then will encourage some kind of investment banking activities.
I would think that there will still be investors who will still have some uncertainties towards the result of the January election. I think if the incumbent party were to continue with governing the country, i.e. there will be no change in government, I think the stability there, the certainty there would augur well for the market. And especially if the result doesn't throw up any negative surprises, and if the government comes out with some new economic policies, I think that would be very positive for the market.
In the urban town area, I would think the actual inflation, I'm not talking about the official inflation, the actual inflation to working adult, in this kind of area, easily come to high single digit, easily. So if you talk about in transportation and all these things, I would think it's double digit soon if the oil price or the petrol price keep on increasing. But the wages has not catch up fast enough to that inflation rate. So the only thing to curb this is, or rather to manage this situation, is to cut your spending. There you are, when you cut spending, you affect the consumption and you affect a lot of things. So you have to manage this situation. So inflation is the main challenge to us.
But the concerns that we may have, or factors that we are looking at very closely, would be the unwinding of liquidity from the market by central banks around the world, be it the US Fed with the proposed 3 interest rate hikes, the reduction in balance sheet. So the pace of this unwinding will be very crucial to markets in general, and we will have to watch if there's any synchronized shrinkage in liquidity around the world.
Well, we think sentiments on the ground to some degree is affected by the consumer tax, which is your GST, while the export numbers have been very positive because of the weaker ringgit that we see in the last 2 years, those benefits has not been directly translated into the end consumers. They are not translated into salary gains or domestic multiplier effect. But it's a matter of time that this will happen. There is typically a lag between how those export numbers benefits gets translated into domestic, how the end consumers will feel it. But it will happen. But this is a typical lag that you should see. Frequently you see 1 to 2 years lag.